Good evening. I would like to welcome you to our webinar this evening, Finance for Cannabis Businesses, hosted by the City of Los Angeles Department of Cannabis Regulation. My name is Natalie Darvis, and I am the chair of the Business Department of Oaksterdam University, the first and longest running cannabis college in the world, and I'm excited to be your moderator this evening. We are here tonight because the Department of Cannabis Regulation has officially launched the Business, Licensing, and Compliance Assistance, or BLC program, to assist equity entrepreneurs in the city of Los Angeles with obtaining a commercial cannabis license and operating a successful cannabis business. This series is part of broader BLC program efforts, which also include live webinars with different subjects and experts, such as the programming this evening, networking events to connect you with other local LA businesses and industry leaders, checklists, worksheets, and other management tools you can download and use, self-directed online education on important topics related to running a successful cannabis business through the BLC's learning management system, which is usually referred to as the LMS, and a robust coaching program that connects applicants with seasoned cannabis subject matter experts. And we're going to drop a link in the chat right now for you to sign up for these coaching services. Please visit cannabis.lacity.org for more announcements on our ever-expanding BLC program. And please also save the date, June 17th, for the next LA Cannabis Unite event at the historic Mayfair Hotel. As part of the city's social equity program, the DCR has launched a BLC LMS portal, where you now have access to these recorded webinars and online courses and digital resources that are made especially for you. Information on how to access this LMS is going to be dropped in the chat right now. Also, please note that there is a module in the LMS already live on the topic of tonight's webinar and has the exact same title, Finance for Cannabis Businesses. This module is extremely comprehensive and covers many additional topics about finance and cannabis than what we'll have time to cover this evening. So I really recommend that you take this course if you have not already done so. So before we get started, let's take a moment to review some housekeeping rules. Please note that this webinar is being recorded and can be viewed after the editing process on the DCR's website. You will be muted with cameras off for the duration of the webinar. This means that your camera and audio functions will not be available during the session. You will be able to see and hear all of the panelists though. There is an open chat box where you can interact with one another for networking or comment on the information, but please use caution when sharing personal information in a public forum and keep your questions focused on tonight's topic, which is finance. Please ask questions about tonight's subject in the Q&A box. We are gathering and responding to your questions throughout the presentation, and we're going to have dedicated Q&A pit stops throughout tonight's webinar. So you are encouraged to utilize the Q&A box at the bottom pane of your Zoom screen. And if you use the Q&A box for questions, everyone can see the answers to your questions as well. And I can guarantee you that if you have a question, many other folks likely have the same one as well. So make sure you pop it in there. Also, finally, please note that tonight's content was not created by the Department of Cannabis Regulation or the City of Los Angeles and is for informational purposes only. This information is subject to change, and it does not replace or supersede the Los Angeles Municipal Code nor constitute legal advice. If you have specific questions outside of tonight's topic on finance, please call 213-978-0738 during the business hours of 10 to 4 p.m., Monday through Thursday, to speak to a DCR representative. So now it is my esteemed pleasure to introduce tonight's subject matter expert, Andrea Unsworth, the owner of Tulip and Oak Consulting. Andrea is a California native and has lived in the Bay Area for over 13 years. Her background is in finance and operations, and she received her bachelor's from UCLA and her MBA from USC. Andrea has a strong finance background, most recently as a bond analyst for Moody's Investors Service, where she rated municipal bonds for local governments in California and throughout the West. And in 2014, she operated a cannabis delivery service in Oakland called Stash Twist. In 2015, Andrea led the Bay Area chapter of Women Grow and was a co-founder of Supernova Women, an impactful group of women entrepreneurs in the cannabis space. From 2019 to 2021, Andrea was a general manager of People's Remedy, a dispensary, and during the same period, she was also the director of compliance for Hummingbird Verde, a manufacturing and distribution company in Oakland. So we all know that she's really good at being busy. And she is currently a board member of the Oakland Equity Collective, a shared kitchen and white labeling facility that supports a cohort of social equity operators for 18 months at a time. And it is a really awesome facility. It's great to have you on this evening.
Thank you so very much. It is an honor to be here this evening as well. I look forward to covering this content with you. We've got a lot of good stuff to share. So we'll go ahead and dive right in here. Let's go ahead and make sure we can see everything.
Looking good so
All
far.
right.
Great.
Beautiful.
Take it away.
All right. Well, greetings and welcome to tonight's webinar on finance for cannabis businesses. This presentation is going to focus on many topics, but I want to ensure that you know there's a much larger module, as Natalie mentioned, on finance for cannabis businesses located on the BLC LMS. And if you have not already taken this module, I highly recommend that you do so following the webinar. Tonight's content is definitely meant for those who either maybe have more cannabis experience than finance experience or vice versa, so that either, no matter what your background is you can bring those two views together and utilize them to move forward in understanding how finance traditionally, how it is special here in the cannabis industry. So why do we need to learn more about finance specifically for cannabis businesses? Well, most new entrepreneurs need to find some source of capital, right? To launch their business. We've heard from many of you that funding is a top concern. So to do that, you'll need to understand the core concepts of business finance and the ways in which cannabis business finance is different than other forms of typical business finance. Every operator needs to understand the financial health of their own business, whether or not you're looking for startup capital. It is an important concept to understand. If you're looking for investors, they'll definitely want to know about your company's financial health. And there are certain financial statements and metrics that they'll expect to see and expect you to understand and provide. Finance can be an intimidating concept for a lot of people. And in general, there isn't a lot of education provided around business finance, right? It's not something that we're typically taught in high school or in most education programs. So unless you're seeking out a specific business class, it may be the first time that you are encountering the world of finance by actually owning a business, right? There's a lot to learn about finance. It can feel overwhelming. And so today's webinar is definitely meant to introduce the basic concepts of cannabis business finance. And we'll have a lot more on this topic to come in the accelerator program. We are going to be talking about these ideas and helping you through the process every step of the way. So today, we'll start at the beginning, learn exactly what finance is, and discuss why cannabis finance is so different. After we do that, we'll look at the two major sources of financial funding, debt and equity, and learn the difference between them. Then we'll look at what you need to know to understand the financial health of your company. And from there, we'll provide some tips on managing cannabis business finances. We'll wrap up by sharing a few options for learning more about finance. All right, so let's start this webinar off by defining what finance is, and then we'll examine what makes finance so different in this particular sector, cannabis. So according to Investopedia, an online educational site, finance is a term for matters regarding the management, creation, and the study of money and investments. It involves the use of credit and debt, securities, and investment to finance current projects using future income flows. So what does that mean? Well, in other words, finance is the process by which companies use money to launch, continue to operate, and then expand their businesses. So finance encompasses a lot of businesses' activities, and it's far more complicated than the day-to-day financial management that individuals and businesses do, a lot of which is confused with accounting. Many people view finance as simply money coming in, money going out, similar to how people balance their checkbook or how companies stay on top of their books. However, finance is not simply a snapshot of how much money a person or a company has on any given day. Rather, finance is how the companies project their need for cash in the future to ensure that they can reach their growth goals. For struggling companies, finance might be more focused on the cash needed to simply stay in business, right? This process involves looking at the historical revenues, how much cash the company does have right now, and then also how much cash will the company need in the future. So finance is more of a future casting process rather than just a daily accounting of the cash being brought in versus spent. So to understand the concept of finance a little bit better, let's first look at what personal finance is, right? Something that we're all familiar with, and we'll see how it's different from business finance. Individuals and households generally bring in cash or revenue, as we say when we're talking about finance, from two main sources, right? Your paycheck or from an investment. So an example of an investment would be stocks and bonds, buying property, selling a house, renting a house out. Individuals and in households also have cash going out, right, to pay for your debts and expenses. So we've got credit cards, home mortgages, car payments, student loan payments, just to name a few. There are also some expenses that have to be managed, right? They fluctuate. Their groceries, your gas, childcare, so on. All of these debts and expenses must be able to be paid with the revenue that's brought in. The household has to forecast what it will need and then essentially go out and bring in that much income, or at least we try. So businesses also have revenue and debt and expenses. They're similar, but they look a little bit different than what we see in personal finance. So businesses bring in cash or revenue from selling a product or selling a service. Businesses also do have investments. They have stocks in other companies they've acquired. They may have rent that they're collecting on a property. Businesses also have a lot of debt and expenses. Usually, one of the largest expenses is payroll. Companies can spend upwards of 80% of their revenues annually on payroll and employee costs. Businesses also have lease payments and equipment that they have to buy, right? So in order to pay for all of these expenses, businesses often carry a line of credit, which is just like a credit card for businesses, but it carries a much lower interest rate than a credit card. Businesses often draw funds on this when they need it, and then they replenish the funds in the line of credit when they have extra cash. So perhaps the biggest difference between personal finance and business finance, however, is that businesses have access to different types of capital that can be used to launch or grow a business that we wouldn't necessarily have as an individual. So many businesses can bring in capital by selling shares of their company. It's called an equity investment, because the company is giving up a portion of its equity or an ownership stake to an investor in exchange for cash from that investor. We'll talk about that in more detail in a few minutes. Some companies eventually go public and offer shares for sale in a publicly traded stock exchange. This process is called an IPO, or an initial public offering. It can bring in millions of dollars to a company, but it does come with a host of new regulatory requirements that are managed by, of course, a federal agency. So now that we have looked at how finance works for most businesses versus individuals, let's look at why cannabis finance is even more different. So if you want to launch a business now or expand the one you have, you could get a loan from the SBA or a bank or just about any type of lending institution for anything except cannabis. So because you want to run a cannabis business, these places won't give you a loan. And why is that? Well, since cannabis is a Schedule I drug on the Controlled Substances Act, banks and federal agencies like the SBA won't work with cannabis businesses because they're unwilling to run afoul of federal law. One of the laws is a requirement that banks carry insurance. It's backed by the federal government. You may have seen this sign, FDIC, which stands for Federal Deposit Insurance Corporation. It's a third party that manages the insurance coverage. The FDIC will not provide coverage to banks that knowingly work with cannabis businesses. So if a bank does lose their FDIC coverage, they have to shut down. So large consequences. Credit unions, though, operate under a different system and do have some more leeway to work with cannabis businesses. But many are still hesitant because the reporting requirements for cannabis accounts are much stricter, and the penalties for violating those requirements are severe. So they could also be forced to shut down if they make a mistake in their regulatory filings, or if they fail to catch one of their account holders who may be conducting illegal activity. So even if you're able to find a credit union that's willing to lend to a cannabis business, they may charge extra fees or higher interest rates because of that extra cost associated around the additional regulatory burdens. So this lack of access to banking does not just apply to loans, right? Most banks won't even offer a regular business checking account. Makes running a cannabis business extremely difficult. Managing cash-only businesses carry, additional hurdles, for instance, security. It's really difficult to pay all the bills a business has in cash. They also bring in their revenue in cash, which makes them a bigger target for thieves. Simply put, it's just harder to manage business finances without having access to banking and financial services. Then there's 280E, which is part of the US federal tax code. 280E states that all businesses that deal with trafficking of controlled substances, like cannabis, are disallowed from taking the normal business deductions that other businesses usually are used to generally reduce their tax liability. So basically, cannabis businesses cannot deduct these costs. And so you end up paying taxes on a significant part of your revenue, almost all of your revenue, in some cases, especially closer to the retail end, which really eats up your profits. Finally, because the cannabis industry has had to operate in the shadow of prohibition for so long, a lot of legacy operators just have not learned about finance. In fact, most have felt that they were putting themselves more in harm's way by, keeping an actual ledger or accounting of the revenues and having things written down. And they pursued more traditional means of raising cash to expand their facilities. So because, obviously it could be used as evidence against you if you were arrested for those cannabis activities. So you need to have at least a basic understanding of finance to be successful as a cannabis entrepreneur. And why is that? Why is it so important? Well, a big part of finance is raising money, either to start or to expand the business. But raising money is just one of the many reasons that you should understand your company's finances. Without a solid understanding of where your revenues and costs have been historically and where they are currently, it's extremely difficult to forecast the amount of cash you will need to keep your business going, let alone expand your operation. So a big part of finance is cash flow management, which is the study of cash coming in, inflows, and cash going out or outflows. Positive cash flow indicates that a company is liquid, means their funds are easily accessible. The company has high liquidity. That means they have the cash it needs to cover their obligations, pay their expenses, reinvest in the growth of the company, and secure a buffer against future financial challenges. Given the usual volatility of the cannabis industry, having extra cash to weather the ups and downs in the market is critical for a cannabis company. However, if a company isn't accurately tracking and managing its cash flow, it's impossible to build up these buffers. Understanding finance is also key to structured growth. Finance encompasses all of the actions a company needs to perform to grow their operations in a logical and adequately funded manner. Expansion often requires companies to borrow money or leverage ownership of their business to fund these expansions. So now we will be pausing here for a small Q&A break.
That was a lot of great, just like intro information on finance. We're starting to kind of get our sea legs here about what are these big topics within finance, so we can start breaking them down more. But I do have a few questions for you. How do you see the probable federal descheduling of cannabis changing how the industry approaches finance?
Well, I think the federal descheduling of cannabis off that will offer additional lending opportunities. I think more banks will be, able to kind of jump in and be able to offer more lending services, more banking services. But with that, we will probably see another influx or flood of operators, right, coming in because the risks have been lowered just that extra bit, and the access to cash has been increased. So with that, we'll also see a jump in the number of players in the industry, I would imagine. So those are the two sides and where I see the change coming.
And I know that a lot of people in the industry are hoping that there might at least be some reprieve from these banking and financial challenges, even in advance of the federal descheduling of cannabis. So I think it's important for everybody to stay on top of those, that news. Congress has attempted to pass, a few bills to try to ease the restrictions on access to banking services for the cannabis industry, but it's never fully made across the finish line in the Senate. So it's definitely important to stay on top of that. What barriers to understanding finance do you see most prevalently in the cannabis sector today?
Yeah, I think definitely, a lot of folks coming in with their startup funds think that it's cost prohibitive. They think that it's expensive. Do I need to hire a CFO and I'm not even really making any money? Is it worth talking about the future if I can't even pay the bills right now just yet? And I think that while those are all valid questions and thoughts, that the answer is yes, you do have to take that time and that budget or that, get that information yourself, because someone from day one needs to be in charge of having a vision for the company and figuring out how you're going to pay for that vision, right? And so even something just that basic, again, like we mentioned in the presentation, hasn't always been taught to us in most educational institutions. In high school, we're not always learned how to take care of our own personal finances, let alone the finances of a business. So often becoming an operator may be the first time that someone has even been exposed to business finances, and it is overwhelming. So it's very easy to kind of look the other way and say, I'll worry about that when I make my first million or when I'm making more money. But I would advise worrying about it from day one so that you can make that first million.
I was about to say, because you're not going to have a roadmap on how you're going to make that cash unless you have a strong command of what's going on with your finances. I really resonate with your comments on a lot of people, their first introduction to finances when they're an operator. And you and I both have an MBA, and I will never remember or never forget the first day it clicked for me in school why my cannabis businesses had not been so successful financially. This was, way back in the day. I was young in my 20s, but I didn't understand finance at all. I was looking at finance as simply cash in, cash out, and not looking at the holistic picture, not doing my future casting down the road to see what my farm was going to need. And it absolutely transformed the way I look at in every aspect of how I run my business. So I think, it's really important that people start kind of breaking down those barriers and learning more about it.
Definitely.
We have a couple questions from the audience. So the first one I'm going to take. Daryl asked, do you have funding opportunities for those that only have an ACA number? So Daryl, I would definitely encourage you to go to the DCR's website and check out the different types of grants that are offered that are run by Elevate Impact LA. And there should be, a lot of information on the website for you to learn more about what are the funding opportunities available to equity entrepreneurs in Los Angeles right now via the DCR. And Jennifer is asking, can customers use debit cards, which is definitely a tricky subject.
So my quick answer is yes. I have run dispensaries where I had that option. Not credit cards, of course, but debit cards, yes. The most common that I've seen where what you have to do is essentially round up. It's called the rounding up trick. So for instance, if their total is, $45.26, you would be rounding up to say $50. And so on the other end of the transaction, it looks like they are using that debit card to pull $50 out of an ATM. It doesn't necessarily show that they're making a purchase. And then the bud tender gives them back that change from the $50 from the 46.58 or whatever as their change for making the purchase. So that's one of a few of the ways that I have seen a lot of the bigger dispensaries do that. It is expensive. Anyone that's going to allow you to put a debit terminal in your retail is going to take a good piece of that. So also keep that in mind. If that then impacts your pricing, your competitiveness, all of those things. But it also is weighed against, folks having the ease of using their debit card and not having to have cash. So, I've seen it. I have seen debit cards, debit terminals used in dispensaries, definitely.
Great response. Yeah, definitely. We need some disruption in this space to make it easier for consumers to use their cards at dispensaries. But again, of course, if we didn't have all these financial restrictions, then cannabis businesses could operate like other businesses and just accept them. But all businesses have to pay fees, right, Andrea? But for the use of debit cards, credit cards, it's actually a really large fee that most new entrepreneurs are not aware of when they first start a business. So keep that in mind. Merchant fees.
Yeah, those 1% here, 1% there start to add up for sure. And if you aren't giving that cost, paying it forward to the customer to cover, then yeah, it is definitely driving into your bottom line.
Absolutely. So you mentioned the lack of business deductions that cannabis businesses can take because of tax code 280E. What cannabis license types are most affected by this tax code and why?
I think the ones that are most impacted are most likely going to be retail at the further end of the spectrum, mainly because they are public facing. So they're going to usually have the higher rents. They're trying to keep, something that's looks pretty and looks nice and is in a great area, which also means your rent is probably going to be higher, as well as your landlord probably is just charging you higher rent, or you paid a pretty penny for it because of the what we call the green tax, the cannabis tax, kind of being allowed to have cannabis there. So with all of those extra operating costs that you are not able to deduct, it does start to add up. On the cultivation and manufacturing side, you start to see some ability to deduct some of the machinery or depreciation for that, but not so much on the retail side, which doesn't have those physical assets typically. So I would say on the scale, probably retail hardest hit, cultivation to manufacturing, depending on how you're set up and whether or not you own your assets, on the other end of that spectrum. And then actually distribution could be at the far end of not being impacted, depending on, again, how it's set up and what their primary functions are, because again, it does depend on how much equipment you have in there and what your property situation is, of course. But in terms of the business that you're actually doing and having to buy goods, it would be at that end of the spectrum as well. Retail is hit hardest. I think retail probably has the lowest margins typically, on average, typically in the game. And again, that's on average. There are retailers, I'm sure, that are doing absolutely great, but That's hard.
Yeah. And historically, these impacts from 280E are so great that I've actually seen cannabis businesses that were primarily focused in retail actually move towards more vertical integration. So they actually have some licenses where they can write off some of these general expenses, which are called COGS, which I know you're going to get into here in a minute. So this was a great first pit stop, and I'm going to let you dive back into the material. Thank you so much.
Thank you. All right. So we have learned that finance encompasses a lot of different areas of running a business. And the term financing is also used more specifically to refer to the act of sourcing capital, money, to launch or grow your business. So many entrepreneurs who are now new to running a business are unaware of the difference between debt versus equity financing. So let's make sure that we all understand the difference between those two terms before we move on. All right. So capital is wealth in the form of money or other assets owned by a person or organization. Capital is often made available for a purpose, such as starting or expanding a company. This way, the way that most individuals or companies access capital to start or grow a business is through financing, what we're talking about today. So there are essentially two primary types of financing. We have debt financing and we have equity financing. Those are pretty much it. Everything is going to fall under one of those two buckets for the first part. So to put that as simply as possible, debt financing, you're taking out a loan. Equity financing, you're giving up ownership, right? Giving up ownership in exchange for cash. So let's take a look at what that means. When you finance with debt, you're taking out a loan that has to be repaid, either to a bank or a private lender. This is also going to be paid back on a schedule, and it's going to be paid back with some form of interest. Occasionally, of course, there are zero interest loans that local jurisdictions have issued in the past, but for the most part, right, the interest is something, even if that something is zero. Debt for businesses and individuals functions fairly similarly. We all understand, right, if we have a mortgage and we don't pay it monthly to the bank, we risk losing our home because eventually the bank will seize that asset, the house. Businesses that take on loans often have to secure their loan with assets as well. They don't have a house, but they may have the property that the business is in. They may have large pieces of equipment as well. When you finance with equity, on the other hand, you are giving up a stake in your company. Then the equity investor, hopefully, fingers crossed, they get their money back when the company is sold. That is the goal. They are not here to get their money back in monthly payments and interim. That, again, we're going back to the debt side. When you're giving up equity, your goal is to sell the company, and so that their stake in the company is worth more than when they came in. So when the company is sold, case of a sale, the value of the shareholders' equity, the value of the company when it's sold, minus any liabilities, right, that are owed by the company that are not transferred to the buyer with the sale. But equity is only worth something to a shareholder if a company is worth more than its liability. So you have to be worth more than what you owe back. So if you have, bought a bunch of equipment or bought a bunch of things on credit, and then you're looking at your cash position, but you still owe loans on those assets, then you want to compare what you owe and what you really have as an asset, which some of this might be cash. You can't just look at the cash and say, oh boy, we are profitable and we're great. You also have to look at the liabilities that are owed against that cash. All right, so let's dive into each of those. First of all, what's debt? Debt is a sum of money that's owed and due. In other words, a loan, you need to pay it back. You're probably familiar with debt in everyday life. We've all had credit cards, credit card debt, car loans, mortgages are all forms of debt. The amount of money that you borrow is the principal. A loan is almost always offered with interest, which is a premium the borrower must pay for the privilege of using those loaned funds. And the interest rate is the proportion of the loan that is charged as interest to the borrower. It's typically expressed as an annual percentage of the loan outstanding. Loans also typically have a maturity date. This is the date by which you have to pay the entire loan and the interest off by. Typical maturity for a car loan, for example, might be 5 years. Where home mortgage, it might be 30 years. When it comes to business loans, maturity date is often negotiable. This is a key factor to consider when you take on a loan, because a loan you have to pay back tomorrow may not be as valuable as one that you have like 10 years to pay back, right? Because you can use those funds to generate more money. There are two primary types of debt: secured debt and unsecured debt. Secured debt is something that is backed by collateral. So a tangible or financial asset, like we said, a house, a car, a piece of equipment. It's something that, car loans and home mortgages are structured this way. It's a secured debt. Unsecured debt is debt that is not backed by any collateral. So it's riskier for the lender, for the person lending the money. So this would be like a credit card, right? There's nothing holding, there's no asset to that credit card that the lender could come in and pick up per se, if you aren't making those payments. Because of that, they have a higher interest rate than something that is secured, like a home mortgage or a car loan. In cannabis, secured debt is most common with cultivation and extraction companies, since the equipment and real estate that that's leased and owned by these licenses can be valuable. Any debt taken out can be secured by the land, or it can be secured by that equipment. So unsecured debt can happen, but there's typically a higher interest rate and an accelerated maturity date with those loans, but they can happen. Cannabis businesses lack access to many of the types of debt financing widely used by businesses in other sectors. Most banks offer short-term loans to business customers, cover operating costs, particularly in sectors that face high upfront costs to produce their products. And naturally, this type of financing would be a great benefit to cannabis businesses, right? So you would be able to go and purchase bulk material or trim or fresh frozen and buy all those on a loan. But we're locked out of a lot of that and those low interest bank financing options. Unfortunately, debt can also originate from sources that are predatory. This is especially common in the cannabis industry because of that lack of traditional forms of debt financing. Predatory lending refers to unethical practices conducted by lending organizations during a loan origination process that are unfair, deceptive, or fraudulent. If any lender is offering you debt financing, you should carefully read the terms of the loan and reach out for help from financial professionals. If you have questions or concerns, you should also observe the behavior of that lender's agent, right? If they're being evasive or they're trying to rush you into signing an agreement, they may have something to hide. So there are some red flags that you should watch out for, including unclear pricing and terms, short loan periods, like just a few weeks or months, prepayment penalties, which are fees that still have to be paid if you can repay the loan back in time, abnormal payment schedules, minimal vetting of the borrowers, meaning like it's too easy to get approved, aggressive or abusive sales tactics, a forced sense of urgency, or if they're unable or unwilling to answer your questions. Many lenders do have to be certified by a state government agency or at least meet the standards as an accredited investor defined by the SEC in order to provide loans of a particular size. So working with licensed and accredited loan providers, even if they're not a bank, That's one way you can hopefully avoid being taken advantage of by a predatory lender. So we talked about debt financing. Here, when we fund your company with equity financing, which is the other option, this is not a loan. This is funding your company by raising money and selling shares of the company. So when you do this, the buyer of the share, they own a part of your company, right? Which that in and of itself can be a scary concept because this is your baby, this is your company. So giving up a part of that, and even if it's in exchange for cash, can be a little scary or have an emotional tie to it. But equity represents the amount of money that would be returned to a company's shareholders if all those assets were liquidated or sold off. So essentially, if all the debt was paid off, all the assets were sold, what would be returned to those shareholders? Equity shareholders own a portion of the company, and in return, they receive a profit of the company if it's sold. Some businesses also distribute dividends, which you've probably heard of, quarterly dividends, annual dividends, that represent a portion of the profits of the company for that time period, with that quarter or that year. In the case of a sale, the value of the shareholders' equity is the value of the company when it's sold minus any liabilities. A single company can sell many different types of shares, each of which grants the holder different rights and obligations. You can have preferred stock. You can have, gives you the right to vote on certain decisions, and it all depends on what type of shares you hold. All these rights and obligations are often detailed. They should be in the shareholder agreement, which is an important document, which details the rights and obligations of the investors and the company that you have agreed to. So 7 months down the line, an issue comes up, you want to say, refer to the shareholder agreement because that's what's going to say, what rights you have to vote on this issue. In the cannabis industry, equity financing is often the only option for new businesses. As we learned earlier, most banks are unable or unwilling to offer traditional financing to plant-touching companies because of cannabis being a Schedule I drug. So startup companies usually hold very little in terms of tangible assets, like we said, with the exception of being, cultivation and manufacturers who may hold some equipment. So the collateral that they have is usually the company itself when they need cash to expand the business. So this is why equity financing is so common in the cannabis space as opposed to debt financing. So does equity investment get repaid like a loan? No, it does not. We understand that a loan has to be repaid, like we said, usually within a specified time with interest and added to the principal. But equity investment is not really repaid because you didn't borrow anything, right? You gave a portion of your company for that cash. Instead, you sold them a portion of the company, right? So when does the investor get their money back? Well, when raising capital via equity investment, you're essentially selling a portion of your company. So you assign ownership shares. If you're the sole owner, great, you have 100% of the shares. But as soon as you take on a partner who is taking half of that, you're now down to 50% of the shares. The size of the ownership stake and the cash given in return for that ownership stake are negotiated between the company's owner and the equity investor, and it's governed again by the shareholder agreement. That should also define how much control over the leadership the investor will take on. Because the equity investor owns a share of the company, they're entitled to a portion of the revenue. They're entitled to a portion of the profits if the company is sold. In fact, equity investors get their money back typically only if the company is sold or merges with another company. So selling a company or merging with another are two of the types of exit strategies for equity investors. And when they invest in a company, they want to have some idea of how or when the owner plans to sell or merge, because that's how they know when they can hopefully recoup their investment. So this concept can be surprising to some new business owners because many have no interest in selling their business. They started it because they want to keep operating it as long as it's profitable and perhaps even someday pass it along to their family or community. However, receiving cash in exchange for equity is not a viable fundraising path for business founders that have no interest in selling their business, because the eventual sale of a business is the foundation of how equity investment works, right? That is the goal. So if that is not your goal, this may not be the way that you go about raising funds. That investor is hoping that those shares sell for far more than they paid, because that's where they get their ROI, or return on investment. In spite of all of this, though, equity financing is far more common than debt financing. This is because most companies, again, can't access rather the traditional forms of coming from a bank or SBA. So just like with debt, there are major concerns around predatory equity partnerships. This issue is especially prevalent in social equity business, and most common where licenses are not available to non-social equity applicants versus equity. So for instance, retail licenses that are only available to equity applicants would be an example. Generally, the most common predatory behavior is when a business owner is required to give over a majority stake in their business in order to secure the capital that they need, meaning giving up more than 50%, because that now means that that partner has a controlling interest. They can overrule the founder on key decisions around the strategic direction of the business and the day-to-day operations. So verified social equity owners may face this dilemma disproportionately over non-equity business owners. In Los Angeles, an equity qualified individual or entity must retain more than 51%, or 51% at least, more than 50. They must retain a controlling interest. But even when an equity owner retains a controlling stake, equity investors may demand voting rights, right, that supersede that of the business owner. That means the investor would then have more decision-making power than the founder. So when a new investor has more voting power of the direction of the business, they can make decisions that drastically change the mission of your business and the spirit of your company. This has been a recurring issue when businesses are merged with larger multi-state operators. Let's say they now want to take this company over into, Florida or into, other markets, and they want maybe a look that is going to, meet all of these markets, which may be very different than, what you had in mind right here in California. So minority owners or founders of a company, they might not be able to stop the merger from happening if they've given up that majority stake. So you want to take that into consideration when putting together the shareholder agreement. Finally, similar to our discussion of predatory debt, investors who exchange cash for equity, they can also use aggressive or abusive sales tactics and give you a forced sense of urgency to try to secure an equity deal that maybe does not favor the original owners of the business. So the best way to avoid these type of issues is to carefully vet their intentions before you offer them an ownership stake, right? Make sure they're not planning on merging your company if that's not something that you want. And it's also important to keep a controlling stake of your company. So keeping more than 50% whenever possible so that you can remain in charge of the decisions that are made for your company. So next we will stop for another Q&A break with Natalie.
Perfect timing. We got some great questions coming in from the audience. So first question from Jennifer, if you don't pay back the secured debt by the maturity date, are they only able to take the collateral agreed upon, or can they try to take back more of your property that wasn't listed in the agreement?
That is a great question. I'm going to, whatever is listed in the agreement when you signed and took those documents, it should have been very clear as to what were these secured assets and what they can then come after. However, because they are making a loan to the business and that is now a debt, and Natalie, maybe you can help me go into a little more detail into at what point they could actually get other assets from the business, because it depends on where they are in terms of the hierarchy. If that business became illiquid or went out of business per se.
Yes. So I think, I know this isn't anyone's favorite answer, but it really depends, Jennifer. So it depends on the contract. It depends on if an individual or if a company that has some sort of liability protection, such as a limited liability company or a closed or open corporation took on the loan. And then, within that, there's going to be a lot of terms that you're going to have to review about what you signed, what you agreed to. I think it's always important for people to remember that they can go back to their lending institution or in their lending officer, whoever they borrow the money from, and ask to renegotiate their terms. So if you are concerned that you're not going to make or fulfill your commitment before the maturity date, I think the first place to start, instead of guesswork, is to call and tell them, hey, I am running into an issue, and try to renegotiate the payback.
Completely agree.
All right. So this is a question that I get and you get all the time. Where can, and this came from YNDS. Thank you for throwing those questions in the chat. Where can I connect with potential investors and funding?
That is the $1 million question.
Yes.
You know, things were different 5 years ago, I would say, when legalization kind of first happened in California, and there was this flood, right? Just like we see in other industries as well. Tech is no different. There's kind of bubbles and booms when investors are more interested and when they're not as interested. So it has unfortunately dried up a bit. It has gotten a little harder to seek those out over time. Also, there are a few that jumped in at the beginning and, you know, have either yet to see their returns or, you know, or there are a few that are doing well. Like there's some people kind of sitting by the sidelines to say, okay, how is this going to pan out for this guy before I jump in? So it's a different market. It's a different time. So where can you go now? I mean, there are still quite a few conferences held throughout the year that attract a lot of cannabis investors and entrepreneurs in one place. And a lot of those can give you, you know, some good bang for your buck to be in one room with, you know, 70 people that are all, you know, hosting different organizations. So keep an eye out for those types of events that come up. MJ BizCon, and you know, there's quite a few that seek out for that exact purpose to bring those folks together. And then Natalie, do you have any other good
I think it's important to note that in Los Angeles, we're seeing a lot of investors as folks who are already operational in the cannabis space. So right now, the only way to get, especially a retail permit, is to ensure that you are teamed up or you are solely owned social equity business. So a lot of the investment that I've seen and a lot of other folks are seeing in LA is again coming from already existing operators who want to expand their business and or operators who maybe are operating in different markets and want to enter into the LA market. It is overwhelming and frustrating to not be able to find access to funds. This is, however, the startup life for everyone. This is not just specific to cannabis. Most startups have a really long journey to figure out and secure the investment that they need to start their company. And it usually happens in successive rounds of fundraising. It's a fairly complicated process. And most companies, if they need a lot of cash, are going to have personnel that are solely dedicated to the fundraising process on their team. So definitely stay connected with other social equity entrepreneurs in LA. Go to events and make sure that you are looking out for any sort of predatory equity. It's not really an opportunity, but offers is probably a better term, because they are also endemic throughout Los Angeles right now. Next question. This is a very specific question. I'm probably going to take it, but I'd love for you to follow up on it if you want to. Because cannabis is still federally illegal, can my company sell shares of stock by having 506 Series D reg documents like a PPM, a private placement memorandum? So, Daryl, this is a legal question, but in general, the SEC does regulate all securities. Now, under Regulation D, there are some exemptions that do allow companies to sell those securities to folks that don't necessarily have all of the correct licensure, permits, education that the SEC requires. But this is a legal question, so I strongly recommend that you go back to the attorney that you're working with, especially whoever you are working with on creating your operating agreement, and ask for their advice. But kudos on such a specific question. I love it. Anything else you want to throw in there, Andrea?
No, I think that summed it up perfectly.
Okay, great. All right, I got a couple more questions for you. So you just mentioned how market volatility in the cannabis sector impacts businesses' ability to take on debt financing. Can you explain what market volatility means? And can you expand more on how this volatility is shaping the current finance options available to cannabis companies?
Yeah, definitely. So volatility in the cannabis market can mean a lot of things. I mean, it could mean simply the seasonality of price changes, because part of, our seed to sale, our plant is actually a lot of times coming from something that is, seasonal. So when you're making, sales at one part of the year after a harvest and you've got cash, another part of the year, you don't have any, that makes it really hard to, for a lender to say, okay, are you going to have the cash every month to be able to pay me back? Because that's a lot of financial, management that needs to happen on your part to be able to, manage your finances throughout the year when you're relying on something that is, every 3 months up and down. But also that volatility could just mean, the politics and the way that things change, but depending on who's, in the Senate, who's in the House, who's president, who's governor. Every few years we could have volatility that then impacts what we're allowed to sell. So for instance, we just had, we're looking at, the possibility of no more, added flavorings, right? And if there's a particular brand that maybe had their forecast for the next couple of years based on a certain level of sales, those sales could change and fluctuate dramatically overnight because of something that happens on the political end, that then that decision trickles down right into your business model and into your bottom line. So that's just some of the volatility that is a little bit more extensive in cannabis than I would say in, some other industries, that we're still seeing so much change and fluctuation happen at any moment. Every 6 months to a year, something happens somewhere in some part of the market. And we just don't really even have 5-10 years of data to say, okay, this type of company typically follows this type of curve. Like, we don't have that data. It's all still a guess for a lender to be able to trust and have, some kind of confidence in lending to a company.
Absolutely. And the same goes with an equity investor. Like you said, there were a lot of sort of early entrants, and now what we're seeing is really a lot more equity investors that are really seasoned in the cannabis space. It's not going to be their first cannabis investment. They may be solely focused on cannabis investment as opposed to, lenders maybe, or excuse me, equity investors, several years ago, they were just interested and excited to see how the industry would play out. But because of the volatility and of course the extreme amount of competition, especially in markets like Los Angeles, you're definitely having impacts on the availability of funds because of this volatility. Well, that was a great Q&A pit stop. Let's go ahead and dive back in.
Okay, get my mute button there. All right, so now that we have learned more about the differences between debt versus equity fundraising, let's examine how a company analyzes the financial health of their company. How healthy a company's finances are is a major determinant of the types of investment and the terms of repayment available to a business owner looking to raise cash. And speaking directly to one of those questions that was just asked in terms of, where do you go to find financing for the cannabis business? That's the first question. And then once you do find them, how do you approach them, right? How do you talk about your business? A lot of times it may be like an elevator pitch. It may be someone that has made an introduction at a party. You're shaking hands. What are the things that you can say or that or they might even ask of you in the first meeting that as a CEO, as an owner, as an operator, you will be expected to know? You're not going to hear, well, I'm not the CFO, so I don't really know that part. There are some expectations as an owner and as an operator in the space that you will need to know about your company and kind of be able to speak to even casually. There are many tools used by financial institutions, analysts, and CPAs to assess the financial status of a company. Most startups and smaller businesses will have to hire outside consultants to prepare their books in order to create the financial statements that are commonly used to assess the financial health of a company. In accounting, there are 3 key reports produced by a CPA that will show, when they're combined, the full picture of your finances. So those 3 key statements are your balance sheet, your income statement, and your statement of cash flows. So let's look at all 3 of those, right? The very first was the balance sheet. This is a financial statement that provides a snapshot. That's a good buzzword when everyone thinks of balance sheet. It's a snapshot of what a company owns and owes, as well as the amount invested by shareholders. The statement reports a company's assets, their liabilities, and their shareholders' equity at a specific point in time. It's usually end of calendar year. It could be end of quarter, end of fiscal year. but it is a snapshot that shows right now at this moment in time, these are the assets of the company. This is what they owe and their liabilities, and this is what would be left over if we were to, essentially cash all that out and pay all the bills. Next, there is, the final thing about the balance sheet, right? It's in the name. The balance sheet should always balance, right? So if they don't balance, there's some problems. So incorrect or misplaced data, inventory, exchange rate errors, or some miscalculations, because essentially it's an equation. It's assets equaling the liabilities and shareholders' equity. Next up is the income statement. So this is also known as the profit and loss statement, or P&L. This is a statement of your revenues and expenses, what came in, what went out. It primarily focuses on the company's revenues and expenses during a particular period. So what was the income statement for Q4, right? What came in during Q4 went out during Q4. This statement is the most recognizable to most folks, as it looks at a quarter, a year, or even a single week of the cash in and the expenses that were paid by the company. Lastly, you have the statement of cash flows. This financial statement summarizes the amount of cash and things equal to cash, being things that you can convert into cash pretty easily, that entered and left the company. So it measures how well a company manages its cash position, meaning how well they generate cash to pay their debts, their obligations, and fund their operating expenses. So their everyday operating expenses to keep them going. The cash flow statement reports on a company's sources and uses of cash over a specified time period. Corporate management, analysts, and investors are able to use this to determine how well a company can pay its debts and how well they can manage its operating expenses. People new to these statements may struggle to find the difference between all the statement's purposes. So let's break down an example, right? The statement of cash flows would measure the source of the company's cash and its uses of cash over a specific period of time. The income statement measures the financial performance. So it's the revenues, the expenses, and then the profits over a period of time. Lastly, there is the income statement shows the profit and whether or not the company generated cash. Sorry. There is no way to create financial statements for a company without having an understanding of the assets that a company owns and the liabilities that it has. So on the one hand, you have your assets. These are items of property owned by a person or company regarded as having value, right? That's an asset. It must be available to meet your debts, commitments, or liabilities. In other words, it's everything of value in your current or near-term possession. Assets are cash, inventory, machines, equipment, property that the company owns. It's also your accounts receivable, right? Money that your customers owe to you, or money for services that they may owe you. On the other hand, you have your liabilities, right? These are your obligations to repay someone else or another entity. So this is money you owe. Some examples might be loan from a bank, taxes that need to be paid, money owed to other vendors, your operating expenses, payroll, et cetera, et cetera. Usually a liability has to be paid by a certain date. It's a current liability if it's in that fiscal year, or it's a long-term liability if you're paying down the lump sum over a number of years. So for instance, a long-term loan. So now that we understand what's an asset and what is a liability, we can look at the financial metric of liquidity, financial liquidity. Yeah. So liquidity, this is an important term. This refers to the ease with which an asset can be turned into cash without affecting the price you can get for it in the open market. So the term liquidity is also used to describe the cash position of a company at any given moment. So these are your liquidity ratios. If a company is highly liquid, for example, they can easily come up with the cash they need to cover their liabilities, even if some unexpected liability arises. That's when you are extremely liquid, right? You've even got extra cash for things that aren't even coming up on a regular basis. Many aspects of a company's operations affect that liquidity. A prime example is how outdoor cannabis cultivation typically has only one major cash event in a fiscal year, right? We just talked about that. It's the harvest. It's the end of the year, at the end of the crop cycle. So this means most of the year, the company's not very liquid because they don't have multiple harvests where they're pulling in cash from the folks that they sold it to to draw cash from. A lot of cannabis businesses struggle with liquidity. The high cost of compliance, taxes, and generally low wholesale price means there's usually little to no extra cash lying around, right? It's probably put aside for a tax liability. In fact, a lot of startups and a lot of sectors, including cannabis, plan to run at a loss for several years before they eventually even turn a profit. So this requires having a lot of cash reserves, which usually comes from outside equity investment. You don't need to be an expert in accounting to raise funds, but every operator needs to understand the metrics financial specialists use to assess the financial health of the company. So what's a financial metric? It is, financial metrics are aspects of financial performance that track sales turnover, profits, expenditures, assets, liabilities, and capital. They're used by organizations in diverse industries to track business processes, improve operational efficiency, and assist in planning and strategy formulation. Financial metrics are often expressed as a ratio, which compares one piece of financial information to another piece of information. So typically, the information you need to calculate these ratios can be found on one of the 3 financial statements we discussed earlier. So let's look at an example and explore a liquidity ratio. So the most notable one is called the current ratio, and it's literally just your current assets divided by your current liabilities. Assets on top, liabilities on the bottom. Generally speaking, if you have 2 to 3 times more assets than your liabilities, that means that's a good current ratio, 2 to 3 times. That's actually really good, probably as a startup. it's excessively good to be able to cover your assets 2 to 3 times. And this is one of the most common tools used to understand the current value of a company, right? What is this company worth right now? Well, how well can it cover its liabilities with the assets that it has? Excuse me. So to use these ratios, though, you'll most likely need to generate the financial statements that we just mentioned. In our current ratio, for example, the current assets and current liabilities, those are all found on the balance sheet. Sorry. On average, most smaller cannabis companies are not analyzing their financial performance much past looking at their income statement to see cash coming in and out. So we're talking about doing, a little bit more than that. This puts you at an extreme disadvantage when you're negotiating with investors, right? Because again, it's important to be able to confidently discuss more about your company than just your current revenue and expenses. Like, oh, we make this much, we may do this much. We made a little bit more than we spent, but what does that mean? What does it mean today versus, 3 months from now? Another commonly reviewed financial metric is EBITDA, which we will discuss in the next slide. EBITDA, it's a fun one. It stands for earnings before interest, taxes, depreciation, and amortization. EBITDA is a metric used to evaluate a company's operating performance. So in finance, this term is used to describe the amount of cash that's generated or consumed in a given time period. So EBITDA is a helpful metric because it evaluates a company's profitability. It measures the cash producing possibilities, right? Without considering things like taxes and what it costs to be lent the money to make those, right? So it's kind of like saying, if we didn't have that, what are we able to generate based off of this investment? So it's giving you kind of the most pure look at how efficient and how well you operate as a business. You can calculate it during the normal practice of accounting. In other words, your company can calculate it from the income statement, from your profit and loss statement, and your cash flow statement. EBITDA calculations can be particularly useful. The first reason is because of taxes. Again, because we mentioned 280E, it's kind of giving you an unfair look at how well the business truly is performing or could be performing if the tax burden wasn't so high, right? EBITDA, it also disregards the cash impacts of equipment depreciation. And if you are a company, a manufacturing facility that's got a lot of equipment where that depreciation makes a big difference on how your statements look, this kind of takes that out and looks more at apples to apples. The equipment depreciates, it loses, value quickly. And that shows up as a liability on your financial statements, which really isn't a true liability, right? It's not really something that you accrued. It's just your machine getting older, right? So as a metric, EBITDA can offer a cannabis business a much rosier financial picture to an investor than just net income. But it can also show a lot more of the potential that can come of the company rather than net income as well. So a company that's looking to take on post money, but which is operating at a net loss, which is really common, you'll have a much healthier cash position if you look at it from an EBITDA position or calculation. For a currently operating cannabis business that is operating at a net loss, being able to show EBITDA growth in your first several years also can garner investors' confidence in your firm's ability to reach profitability down the road, right? You're kind of burdened at the beginning, but once you get that growth up, you'll be able to, overcome that, and you can see that through an EBITDA calculation a little better. So it gives a little bit better picture, and you could say it's a little rosier, a little more optimistic, but in some ways a little more realistic as to the efficiency of your business model. All right, so we will pause for a few more questions.
Yeah, they keep coming in because this is such a hot topic. Okay. Daryl asked, in both of your experience, how much money do you believe a person needs to launch a cannabis business in Los Angeles that does delivery, distribution, and they wrote non-volatile cultivation, but I'm guessing they mean non-volatile extraction. So again, the answer to this is it depends, but
that was delivery, non-volatile manufacturing,
and distribution.
Oh yeah. I mean, first of all, it's how big do you want to be, right? And what kind of cultivator do you want to be? What kind of manufacturer or distributor do you want to be? It can go from transporting folks' products on behalf of them up and down the state, all the way to actually producing massive amounts of pre-rolls and packaged flower for companies. So, again, to Natalie's point, it does depend. But I guess if we're looking at like bare minimum to start a cannabis company in any part of California, I don't know, I'm thinking a $250,000. I mean, you're looking at it varies so much because if your rent is $10,000 a month, right, you could be through $250,000 real soon. So there are a lot of variables to be able to even throw out a number, unfortunately. But whatever you think it is, it's probably going to be a little bit more.
Yeah.
I can definitely say that.
Yeah, and generally in LA, we think it takes about $500,000 to start a delivery business. Distribution greatly depends on how much activity and distribution you're planning on doing. Is it that you're planning on securing your own items for your delivery business, or are you planning on securing items and selling to other licensed retailers? And then when it comes to manufacturing and cultivation, it's really huge spectrum of costs. Generally speaking, a cultivation operation is the most expensive license type to start because of the sheer volume of equipment that you need in order to be successful and compliant. So, Daryl, if you were planning on starting all of those, or planning on engaging in all those cannabis activities, you would be looking at several $1 million most likely to get that all up and running. Many entrepreneurs might choose to focus on one over the others at first and make sure that they understand how to operate a cannabis business and try to get to the place where they're bringing in some profits to be able to self-fund the expansion of their company. But I get that's tough. All right, next question I'm going to take. Daryl also asked, where can I get a business plan template and a budget template? So Daryl, I greatly encourage you to check out the BLC LMS that we discussed earlier. And we can go ahead and drop in the chat the access information for the LMS, which also has a far more robust module on this exact same topic, finance for cannabis businesses. But within the LMS, there are a lot of tools such as a business plan template and by license type, there are modules that are going to explain how much it's going to cost to start many of these businesses in LA or California as well. All right, so we got about 20 minutes left and one section left. We're doing great on time. I can't wait to dive back in. But before we do that, I do have just a couple more questions for you. So I've heard that a lot of companies looking to raise funds will try to present their cash position using the EBITDA model you just explained. Are you seeing this as well? And if so, do you think that folks that don't have a strong command of finance so that they can run these metrics like EBITDA, do you think they're at a disadvantage in trying to raise capital for their businesses?
I do think it's an important model to understand. I mean, I think we're talking about like basic entry level finance conversations with someone who's going to be investing, what could be millions of dollars into your company. So I do think that that is kind of a starting, really good starting place. And as I mentioned in my explanation of EBITDA, it does give a rosier picture, which is what you want when you're seeking an investor. You want the rosiest picture possible without being, misleading. Obviously, none of us know what the future holds, but you want to be able to show that your business model holds true and can be profitable despite, other things that are, just showing up on the financial statement. So I think, I personally think that no, you're not at a disadvantage. Sorry, I'm remembering how the question was phrased.
Are you okay? It's more like, do you think that folks who don't have a strong command of finance, like folks who aren't necessarily like quickly able to be like discussing their EBITDA calculation for their business, do you think they're at a disadvantage in trying to raise capital for their businesses?
Yes, I do, definitely.
Yeah.
At this point, again, like I said, because we're talking about, someone giving you millions of dollars, I think there's an expectation on your side of things that you will have a good grasp, or at least come off to have a plan of have a team with you. I know this much, but hey, I've got this CFO who's got, who's done this before, and maybe I can set up a time, where all three of us can talk, things like that. But you are expected, I said at the outset, you're expected to have a baseline level of understanding of how this money is going to generate more money in the business that you're trying to borrow for.
Absolutely. And when I see people looking to take on additional equity investment for expansion is where I see the EBITDA calculation as being really, really critical, because like you said, it's going to give you a picture of what the business's profit position might be without the burden of 280E, because we're taking taxes amongst many other categories out of how we're looking at what sort of cash is left over after you take out general expenses, but not taxes, not depreciation, not amortization. So I think if you're a business that's looking to expand and take on additional equity investors in order to expand, you're going to want to be able to run these calculations so you can show positive EBITDA growth. A lot of cannabis companies can show positive EBITDA growth while at the same time not being able to show positive growth in profits because, again, of 280E. So it's a really valuable calculation right now in the cannabis space. All right, well, let's go ahead and dive back into this last section here on financial management and learn about some more tools.
Alrighty. Let's wrap up the webinar by looking at some ways that you can manage the financial health of your company. So there are a lot of tools available to you to better manage the finances of your company. And I hope that through tonight's webinar, and maybe even just through experiences that you've already had in running your business or other businesses or seen friends running their businesses, that you've come to realize, like, yeah, this is, pretty important. And even if I don't, understand 100% of it, I should try to understand 20 to 25 and find, team members that will take on that other 75 to 8%, because it is an important component of your business and how it runs now, but more importantly, how you can get it to the next level. Because even if you're doing okay today, again, with those changes and that volatility that we've noted, if that's going to change on Friday because one small, piece of legislation went through, or your roof leaks and you didn't have the cash, and that shut you down for 4 weeks, and therefore you lost certain accounts who needed you to continue manufacturing, et cetera, the more that you can buffer against that and plan for that, and have a business model that shows profitability, even if you change locations or were to move buildings or what have you, or change your staff. I think that those are all things that you as the CEO need to be able to articulate and understand, how your finances impact your decisions and how your decisions therefore impact your finances, right? So the first is to ensure that you are regularly looking at your books not just picking them up and looking at them and putting them back down, but meaning that you understand the cash and revenue that's coming into your company, that you're even auditing your accountant to some extent. There are a lot of software applications you can use for this. The most widely known tool is QuickBooks. QuickBooks is super friendly. And of course, there is an option to have your accountant or your CPA have their own login. So you can just do what you need to do on your end, whether it's link it to your POS, if you're a retailer or whatever system you're using, and then your CPA or financial management team can have their own logins and look at what they need to look at as well. QuickBooks will generate those financial statements that we talked about, like your income statement, your balance sheet. So again, we mentioned those were important, and QuickBooks will help you with that. You can also consider hiring a financial controller. Remember, a financial controller is not a bookkeeper. A bookkeeper keeps track of your day-to-day expenses, an important role, but very different than your controller, who is understanding how the company is performing, right? You've heard the term, someone that's getting lost in the weeds. That would be the bookkeeper that sees all of that detail. You need someone who can take all of that and keep a big picture. And if it's not you, a financial controller would be great for that. Generally, you don't need to bring in a controller until you're making maybe 5 million in revenue. But if you're looking for an investor, having someone with that specific experience in financial management, that will help you attract those investors, right? And show them that you're ready to manage that level of funding or manage that level of revenue. Because even if you're making $1 million today, if you want to be making 5 million, right? It's like they say, you dress for the job you want, not the one you have. So you want to show them that you're able to manage even more than you have at the moment. But perhaps the most important tool for you is to spend the time it takes to learn more about finance. And this is the absolute best way to understand the financial health of your company. So let's look at some free and low cost options to do that. One low cost option is local community college. Los Angeles Community College has a finance and banking program that's designed to assist students with understanding corporate finance. East LA Community College has an associate's degree in business administration that heavily focuses on finance topics. Both of these options would be great places to start learning about your finance as you're starting, your business. Another free option would be the online education company Coursera. This company curates online classes from top universities around the country and then makes them available for free to people who don't need to take them for educational credits. You just want them for the actual information. There's a ton of finance courses on that site. Another great and free option, of course, is Investopedia, which we've used in some of today's webinar to define many of the finance terms we learned. It's an incredible resource and tool, contains a lot of articles, self-paced learning options, videos that explain every aspect of financial management. Makes it really easy. It's got hyperlinks for any of the concepts or terms on the site. So, crafting the right team. Even when a business owner has a deep knowledge of finance, it takes the whole team of a company to guide a financial strategy. That means picking the right team is really important. You want to recruit someone who has some experience in finance or is willing to learn more about it on the job. You need a bookkeeper. This function is often performed by the general manager of a company when you're small. You can, like I said before, you consider hiring a financial controller. In addition to your bookkeeper, you want a CPA, at least someone that you know that you can call on a quarterly basis and that will do your taxes for you. File your tax returns correctly, and they have to understand the restrictions on deductions you can take as a cannabis business, and also just the specifics from the CDTFA around running a business, right? So for instance, excise tax used to be collected by distribution companies. Now it is collected by the retailers. Your accountant needs to have a full understanding of what that means. And if you're equity, it has even more implications on how you can get 20% of that money back if you are a retailer. So they need to understand, how things change in the cannabis industry, or you will potentially not only overpay, but you could be missing out on credits that you actually do that you do qualify for as well, even if it's just at a state level. Your CPA can also be there to assist in generating those financial statements or just reading them and helping you with them from QuickBooks. You also want to make sure that your managers are focused on strategic growth for your business, and that's in all departments, right? From your sales department, everyone that's involved, they need to be on the same page in terms of how you want the company to grow and what your strategy is. Because they can also provide you feedback, right? If they're boots on the ground, if they're seeing the products that are in the dispensaries, if they're, actually talking to the vendors, they can feed that information back up to the decision makers who maybe aren't out, boots on the ground and aren't understanding, what people are smoking in May versus what they were smoking back last October, right? So there's a back and forth and a communication that needs to happen, and a transparency for everyone in the business at every single level. And so when teams are able to access and understand the financial position of the company, they understand, you say, oh, our budget's tight. Well, why is it tight and how is it tight and what can we get wiggle room on, right? It puts your financial strategy at the core of your company culture, and it helps in the decisions that you make and why you make them and how you make them. All right. Well, that wraps up.
Great job.
Some great
You made it
content
to the end of that content. Yeah, you can go ahead and stop your screen share. And I just have a couple final questions for you. Someone in the audience asked, and you were just discussing this, so we can kind of provide a synopsis here. Can you share the necessary financial professionals someone's going to need to have on their team as a cannabis startup?
Definitely. As we mentioned, you definitely want to have a CPA, right? This is the person that's going to file your taxes every year. And you want to keep good communication with them throughout the year. Don't just call them in March or April today's tax day. Don't try to call them today for sure. Don't try to call them tomorrow. They're probably resting. But definitely creating that relationship with a CPA. Having a bookkeeper, or at least using QuickBooks, and having someone who is knowledgeable on QuickBooks or who's willing to learn. You don't have to know today, but there are a lot of great QuickBooks training guides, modules, and ways to learn QuickBooks. It's pretty self-explanatory for the most part, but again, that's where that communication with the CPA, as long as your CPA can only produce reports, data out is only as good as data in. So if you're the one inputting stuff into QuickBooks, or you're linking it to your POS, if you're a retailer, right? That's great, and that communication is going forth. But the reports that come out on the end, it's only as good as how you set it up on the front end. So a CPA, a bookkeeper / bookkeeping system. And then it just depends on how comfortable your CEO is wearing these other hats of like a general manager, a forecaster, a decision maker. If they are comfortable wearing those types of roles, great. If not, you are going to want to bring someone else in, bring a partner, hire someone who can be the strategic leader for the group, right? And who can kind of combine all the data coming from all those different places and create some kind of a strategic vision. Hopefully that is the CEO, but we know that a lot of times, even particularly in the equity community, that the person that qualified maybe thought they wanted to be the CEO, and they realize, I just want to be more of a GM and an owner. Your operator and your owner are not always the same person, and we're seeing that trend actually increase here in the cannabis industry. We've seen a lot of dispensaries after 2 or 3 years, what have you. They're like, our name is big, we've got a nice name, it brings people to the doors, but I don't want to do this anymore, or I want to shift gears, but I still want this to operate, so I might bring in another operator. And I apologize, I'm getting off track of the original question, but my point is,
I think this is all great info though. Yeah.
My point is just that you will, as a CEO of any business, be required to wear a lot of hats. And if the finance hat is not one that you're willing to wear, you will need to fill in all those gaps with folks who are comfortable with it.
Absolutely. And for most businesses, once they bring in about 500,000 of revenue annually, they're going to need a financial controller. And at about $1 million of revenue annually, you're going to need a chief financial officer. But along the way, you're still going to need someone who really deeply understands finance and is able to help your startup grow. So, again, there's lots of folks you might need to bring in, and it kind of starts with assessing your own understanding of finance and your own appetite to learn more. And definitely check out the module in the LMS of the same title, Finance for Cannabis Businesses, to learn even more about these topics that Andrea brought up this evening. All right, I got one final question for you. So to close out this webinar, what final advice do you have for social equity cannabis operators in Los Angeles concerning financial management?
I would kind of sum up all of today's webinar by just reinforcing how important this is from day one to have a grasp of, an understanding of, and a plan for how you will maintain, your financial management throughout the continuity of your business. We're talking about an industry where on the federal level, this is still a federally illegal substance. And at the state level, a lot of us are receiving, especially as equity operators, receiving funding, grants, loans from local jurisdictions where those funds are being generated from the state, essentially from taxes, taxes that the consumers are paying. And so as time goes on, you want to be able to report back on those, even whether you're asked or not. The federal element in and of itself is a big enough reason to make sure your taxes are filed correctly. You are tracking every dollar of this and every gram of the cannabis itself, right? Because there's nothing worse than, not doing something because you didn't know, and having to pay the consequences. There are things that are done on purpose where people are just trying to skirt around and trying to, unfortunately, move pieces over here where they shouldn't be moved. But if you weren't doing that on purpose, if it was just, not being knowledgeable or not having someone on your team to work with you on that, that is kind of heartbreaking, right? Because it's just that you didn't know. So let's all make a commitment to know and to understand and to find those folks that will be resources for us in our business, and on our team.
That's a really great piece of advice. Well, thank you so much for your time and joining us this evening. That was a really informative webinar.
Thank you so much, Natalie, and thank you, everyone. And thank you, City of LA, for having me. Of course, both my alma maters are LA, so
Yeah.
it was Bruin and Trojans. Let's go.
Love it. Thank you so much.
Have a good night.
You as well. And thank you all for attending this informative webinar offered by the City of Los Angeles Department of Cannabis Regulation. This webinar recording will be found on the DCR's website, cannabis.lacity.org, shortly. Also, please remember to check out the module in the BLC LMS that accompanies tonight's webinar with the same name, Finance for Cannabis Businesses. So now for some fun and networking. Please RSVP for the LA Cannabis Unite event at the beautiful Mayfair Hotel on June 17th. If you are an equity entrepreneur and interested in boothing a table, please use the registration link that we are dropping in the chat right now. There is a limited number of tables available, so please respond as soon as possible. The afternoon of this event will also feature a supply chain speed dating from 3 to 5 p.m. So what is this? The goal of supply chain speed dating is to have social equity brands and products on dispensary shelves. Equity operators will have the opportunity to meet with cannabis industry distributors and brands for the chance to pitch their businesses to industry decision makers. Supply chain speed dating is a great way to meet people crucial to expanding your network and getting your product in front of consumers. So if you are a buyer or a seller, please tell us that you want to participate in the speed dating event again on June 17th at the Mayfair Hotel by emailing LAUNITE, LAUNITE at oaksterdamuniversity.com. We're going to be dropping that email in the chat right now because it's kind of a mouthful. So definitely make sure you copy that before the end of the evening if you would like to join us for the supply chain speed dating, which is surely going to be a great event. And from 5 p.m., the rooftop area is going to feature a DJ, food, and networking, and a no-host bar will be available in the lobby. I'd also like to alert you to some upcoming educational programming being offered by the DCR. First off, we still have a lot of availability for social equity entrepreneurs to get a business coach through the BLC program. This is a consultant who's dedicated to helping your business succeed. And the way that you sign up for this service offered by the DCR is you start with a 15-minute phone call to get acquainted with what your specific needs are, whether or not you're still considering what type of cannabis license you want to pursue, or you are moving through your business planning process, or if you're already operational. There are specific coaches to help you with all of these needs, as well as coaches to help you with workforce development if you're starting to hire people and expanding your business. On May 16th, from 6 to 7:30 p.m., we will have a Zoom panel event featuring several attorneys who specifically work on drafting and litigating operating agreements in the social equity cannabis space. This panel is going to discuss many of the current and ongoing issues that equity applicants face in creating a viable and equitable operating agreement with partners. So please mark your calendars and attend. Again, that will be on May 16th. It's going to be called Understanding Operating Agreements, and it'll be from 6 to 7:30 p.m. So that's a great event. Please don't miss it. And the next webinar in our current series is going to be next week on Wednesday, April 26th, same time as tonight's webinar. And the topic of next week's webinar is going to be, what are the available license types in Los Angeles? So if you're still considering your options, I would definitely check out that webinar next week. And further, if you have any questions on accessing your account, please email dcr.sep@lacity.org. I'd like to thank you so much for joining us this evening. I hope you have a wonderful night, and we'll look forward to seeing you real soon at the next webinar. Take good care.